All right, I'll go ahead and get started. Welcome anyone sitting in on I'm Brian Allen with Collab Lending, and this, of course, is about reverse mortgages. I have been doing them for, oh man, 16 years. And part of the background and the reasons I started doing it was because both of my parents were becoming of age to qualify for a reverse. I'll get in that story in a little bit. But my brother and I actually started the reverse mortgage lending division of the company we were working at the time. I'll start with the definition, the official definition. A reverse mortgage is a loan available to homeowners 62 years and older. There are some private label ones that allow for 55. It allows them to convert part of their equity into their homes into cash. There are a lot of myths about reverse mortgages, and after my webinar last month, I really feel compelled to keep doing these because it has enlightened so many people, and even those who weren't believers, who reached out and had some questions that I guess they thought might be tough, but I've been doing it long enough to quell any kind of uh, misgivings that they may have. And you see that National Reverse Mortgage Lenders Association have the website there. That's one of the first things I advise people to do is just go to that website. It's a objective third party. It's like the watchdog group for reverse mortgages, and any information you would need that wouldn't come from someone like me, you can find in there. Really helpful. So I advise utilizing that. Let's get right to it. The first myth of the reverse mortgage is lenders own the home. This is not true. Just like a forward mortgage, your name is on title, and at whatever point you pay it off, the title comes to the borrower. That myth came from the early derivations of the reverse mortgage. They were it started in the late 60s, and they were proprietary. Individual banks had their own rules about that, and they would have certain caveats to those reverse mortgages that would allow them to take your house. And actually, today there are some lenders, some banks who have some of those same type of caveats. And this is the most important thing, the FHA HECM home equity conversion mortgage is the one that 99% of the people use out there. And that has been a godsend for so many people because all of the things that made reverse mortgages not so enticing were addressed by that. And I know that shocks a lot of people when the non-professionals get involved in loan programs or making rules, usually gets messed up. But they did it right with the FHA home equity conversion mortgage, otherwise known as the HECM. And that is the one I can't stress enough that you want to pursue, no matter what lender you're looking at. If it's a bank, you really have to ask some very in-depth questions, which you probably will know what to ask once this webinar is over. But these myths are where you would divide those questions. So if you're talking to a bank, I can specifically name Chase. You want to ask them, do you own the home when we do this loan? Ask all of these myths, ask these questions of that bank. If it's a broker like myself, or if it's correspondent lender, you want to just ask the question first: is this a FHA HECM loan? That's the simplest question you can ask. Because if it is, you're going to be in good shape, unless they have some overlays, and overlays are like a rule that they'll put on top of whatever FHA says. First question: is this a HECM? And then you can ask all the questions about these myths that I'm bringing up. Myth number two: they can take your home if the loan amount exceeds the value of the home. The only way they can take your home is if you don't pay your taxes and insurance on the home. You don't upkeep the home. Or if you're out of the home for more than 365 days, there are some rules attached to the reverse that actually make it a little bit more appealing than, say, a forward mortgage when the homeowner passes away and the heirs may want the home, which I will also get into. Myth number three, the home must be free and clear of any existing mortgages. Also not true. One of the first things that happens when we do the calculation, if there is an outstanding mortgage, that gets paid off first and gets rolled into the reverse mortgage. Obviously, the lower the balance, the more access to reverse equity you're going to have. The older you are, the more access you're going to have. And they use actuarial tables in their algorithm. And you know, the obviously the idea being, if the older you are, the less chance you're going to be in the lower amount of time you're going to be in that mortgage. Yeah, that, and there's a on the reversemortgage.org website, there's a calculator that's pretty darn accurate as to what you would be able to access. Myth number four, once the loan proceeds are received, you pay taxes on them. The equity in your home is your equity. It's your money. You do not pay taxes on them. But you do want to check with whoever the administrator is with your Medicare to make sure. It usually does not. Sometimes it'll affect Medicaid, but Medicare does not affect your Medicare. So there's another question you would ask when thinking about a reverse mortgage. Number five, the borrower is restricted on how to use the loan proceeds. Now, there is no limit onto how you use the fund. Obviously, there's limits on how much you can access, but not what you can do with it. Some people do it just because they don't want to have a mortgage payment, and it gives them a net gain in their monthly cash flow. For example, I had a couple in central Pennsylvania. They were 78. He was 78. And he wanted to do a reverse mortgage. He really just wanted to have $1,000 free and clear. And when we did the calculation, based on his age, he was only gonna be at about $700 or $800 a month, I believe it was. And so if you look at that second bullet point, says monthly payment, term, and tenure. Tenure means like as long as you're going to live in the house. Term is you can pick any year amount and plug that in. And let's say like a tenure at 78, 28 years is a pretty long time to be in that home because you're going to be 100 years old. But what if, and as in the case with this person, I started looking at terms to see, what might get his number to 1,000 a month that he would have available to him. And I just started with 20 and I moved down to 15, and it ended up being a 12-year term, which would have put him at 90. And I asked him, do you think you're going to want to live in this home at 90? And he said, probably not. So at 12 years, that got him another, it was 300, he was going to get 700. It got him another 300. So he was at $1,000 going a shorter term instead of the tenure, meaning tenure as long as you are in the home. And then the other thing, the third bullet point is lump sum. You can take the payment as a lump sum. Now, there's some rules to that, which, if you're interested, you can always reach out to me and I can get into those. But with this same gentleman, they had a car payment, and there wasn't a lot left on it. It was like $1,800, maybe $2,000 left on that payment, and it was $167 payment. So what we did was we also used some of the equity of the home to pay off the car. So that gave him another $167. So now his net positive cash flow was $1,167. So that's how we accomplish that. And if you go to the reversemortgage.org, which is the term for them is normal, the normal website gives you examples of what people have been doing with their reverse mortgages. Some people buy Winnebagos and travel the country. They have this extra money and they want to go see the world, so they or see the country and they get a Winnebago. There's one guy down here in Florida, around the Ocala area, and it's a community of pilots, and they have their runway is their driveway. So their plane is parked in their driveway. They pull out, they're on the runway, they take off. He used his reverse mortgage to build his own plane, his own little cute prop plane. So there is no restrictions on what you can do with it. I always like to start with the end game and ask questions about what potential borrower's pain is. The example I gave you, his pain was he just wanted some cash. He didn't want to be house poor and not have discretionary income at the end of the month. Some people, it's about having some long-term care, so they pull money out, and there's some legalities of how you do that and how you're able to do that, to make sure that they're taken care of, um, if they have to go into a facility or have to have home care, because a lot of people just want independence, and independence can mean having someone come to your home and not moving out of the house. Those are lots of discussions go on. That I think it's important to bring up. Not a lot of people do reverse and forward mortgages. I do both, but a lot of people don't. A lot of forward mortgage advisors do not do reverses because it's a longer process. You have to take your time with people. You can't rush them. It's not a transactional loan. You develop the relationship with these people. You develop a relationship with their family. I invite any family member or any person that the potential borrower trusts to sit in on any of my consultations, so they can have an extra set of ears and eyes and ask questions that maybe that borrower doesn't have. And sometimes it takes a while. I've my parents are great examples. My father was a CPA, and he understood the numbers of a reverse, and he knew that we didn't want the house, and he was very anxious to get into a reverse. My mom, on the other hand, she goes in and out. There's periods where she won't even talk about them because she thinks they're horrible or she doesn't understand them. And then, I explain some things and then maybe she's interested, but it's been easily 12 years and she still hasn't made the move, even though it would make her life a lot easier. But it's not my job to make anybody do a reverse mortgage. This is my job is to help facilitate easing whatever pain they feel they may have. All right, on to the next myth. Myth number 6. Only poor people or those in dire straits need a reverse mortgage. As I mentioned in the previous slide, there's many reasons why people do this, but a lot of it has to do with independence. Seniors want to be independent, and people are aging. Not only is the population getting older, but their quality of life is getting better. Great book, The Great Age Reboot. Just a little, I don't have any financial attachment to it, but that's a great book for all of us who are getting a little bit older. Myth number 7. You can only use a reverse mortgage for refinance. Not true. You can use it for purchase, and I'm going to get into the purchase side of it here in a second. But I actually want to go back to the home must, I'm sorry, myth number 2, they can take your home if the loan amount exceeds the value of your home. And that last part where the forward mortgage is more favorable. Here's the deal with the reverse. When you're doing a forward and say the heirs of that person who passes away or moves out, the loan does come due, and you have 30 days to decide what you're going to do with it. Meaning, if you're going to sell it, you have to show that you have a contract with the listing agent, or if you're a sale by owner, you want to be able to prove that you're listing it. And then at that point, you have 6 months to sell the home and pay off the mortgage. If it's priced right, especially in a market like this, anywhere in the country, it's going to sell. But let's do worst case. Let's say he's getting close to 6 months and the house still has not sold. You can apply for a 90-day extension um, on the home to give yourself a little more time to sell it. And then after that 90 days, if it still hasn't sold, now we're at 9 months, you can apply for another 90-day extension. This is the FHA HECM loan. Again, these are the questions you ask somebody who is a mortgage advisor who's talking to you about reverse mortgages. So what that means is you have essentially a year to sell the home. Forward mortgage, you have 90 days. If say the heirs do not have the money to pay on the loan, you have 90 days before that house forecloses. In a reverse mortgage, you have a year. And the question I often get is, what happens at the end of that year? Here's another great question that you need to ask whoever is advising you on the mortgage, on the mortgage advisor. Uh, Banks aren't in the business to hold real estate, right? So if that house and the formula makes sure that you're not accessing all the equity in the home. Uh, it used to be your age minus 13. That's how much of the equity you'll have access to. They've lessened that number because they don't want anybody being upside down in their reverse mortgage. Now, it does mean some people won't qualify who used to be able to qualify, but it also means most people aren't going to be upside down in their mortgage. But at the end of that year, if the house is still making whatever the interest rate is making a profit, they'll usually work with you past that year. The lender will of a HECM loan uh, to help you sell that house because they're still making money off of it. They don't want to own that house. They're not in the business of selling real estate. So uh, when it comes to the foreclosure aspect, if the heirs can't pay the mortgage, the reverse is definitely puts you in a better situation. And the other thing is, I always like to ask the kids if they want the house. Like for myself, my father knew none of us, my brothers or I, we didn't want the home, so we gonna sell it. So burn it while you have it. Burn the cash. You changed my diapers when I was young. It's your money. You use it. And that gets me to the case study. My stepmom. So my father passed away a year ago. We were in the middle of doing a reverse mortgage for him when they sold the house. You can actually purchase a home with a reverse mortgage. Now, most people, when they want to downsize and they don't want to have a mortgage, they'll sell their big house, take all those proceeds, and buy with cash that house so they do not have a mortgage payment. And that's typically all you're going to be responsible for is paying your taxes and your homeowners insurance, and you won't have a mortgage. So the case studies tell me who is my stepmom. So when my father passed away, Toby now, who also was over 62, could qualify for a reverse mortgage. Now, in the typical downsize, she would not have been eligible because she wasn't eligible for a forward mortgage, at least for the type of home that she wanted to live in. She didn't have the income. She wouldn't have the income, even with my father's half of his Social Security and whatever retirement. She was not going to qualify for a forward. But I also didn't want her to be house poor and not have a rainy day fund. So their 6-bedroom, 4,400 square foot house sold, and for her, it sold at 735. It had a 305 balance. After the realtor commission and all was said and done, she ended up having over $100,000 to play with. Uh, Factoring in what the loan amount was going to be for the reverse. So let me show you what those numbers look like. This is called a talc, and what it is the first piece of the puzzle. There are a lot of stop gaps in the reverse mortgage for people to walk away, to make sure that the senior is not being taken advantage of. And the talc essentially gives you what you're going to be getting yourself into. And you see it in the calculation. Her stepmom's age is 70. It has the interest rate. There's a maximum loan amount because it's a government, it's an FHA loan. And the principal limit is how much that she was going to have available to her. And the cash due from the borrower, that's how much she was going to have to put down. So the house being $418,000, if she wanted to do the cash transaction, she wasn't going to have enough for a cash transaction, first of all. But she was able to keep money because she was going to have a reverse loan. She was going to have to pay $288,000 ish as down payment. And she was going to have money left over. The loan amount was going to be 159 ish. So this is the first part of the trend. What happens, and so we don't even give her the talc. What a reverse mortgage borrower has to do is they have to have counseling. They have to reach out to a counselor, and I help with find the counselor in their area, and they're an objective third party, and they give them advice on what goes on with the reverse, so that they know what they're getting themselves into. And we can't go any further than this until they do the counseling. And then once they do the counseling, we can do an application. So they can't do a reverse mortgage borrower can't even do an application until they have the counseling. Now we can run these numbers, because really all you need, and this is something you can do on the normal website, the reversemortgage.org, is just plug in, ask for your age. It'll ask for the address of the property. And by age, I mean, it'll ask for your birth date, and it'll round up. So if you're, 65 and a half, they'll consider you 66. So you have access to more equity. If there's a remaining balance, they'll ask for that. And then it'll just tell you what you're going to qualify for, and you can mess around with the numbers. So part of that first that talc that we get, it'll show an amortization schedule, and it shows us over the life of the loan, essentially, what your balance is going to be on your loan, and it shows you what's your value. And I usually use a 4% appreciation. Homes have appreciated at 6% historically. There's obviously some ticks down and some ticks up, but average is 6%. But I always like to use 4% as the appreciation on a home. And then it shows you the equity, and it shows you how much equity you have based on your loan amount and what the value of the home. So all the way to the right, it shows your equity, and you'll see that my stepmom would have equity, positive equity, up until years 11 and 12, and then it starts becoming negative equity. In year 11 and 12, that puts her at almost 90, right? And so that far down the road, maybe there's another decision to be made. But remember, we've used the 4% appreciation, so 6-8% is more likely. So more than likely, she won't ever be upside down in this property. And the myth about owing more than the house is worth. When I gave you that scenario about the selling the house, if you sell the house and the balance is higher than the loan amount, you only owe what the house sells for. So let's say the house sold for the balance was $1 million, but the house was only worth $900,000 at the end of the term, you don't owe $100,000 in the HECM reverse mortgage. Another important question that you would ask a mortgage advisor who's advising on a reverse mortgage is, will the heirs owe on it? And again, individual banks have tougher rules about reverses. So the HECM, the guidelines of the HECM, you only owe what the house is worth. So if it's upside down, the heirs just walk away. So in her scenario, again, by the time she's around 90, she probably wouldn't. I mean, she would totally have equity left in the house, and then you just have a discussion and have a game plan that you had established in the beginning before you even got into the reverse um, application. Is what is the end game? If you know you're going to sell it, then your heirs will know what they're going to be able to split when the house is sold. Or if the heirs want to keep the house, one of the things I tell them is, do you understand the present value of money? And if you can access that money now and put it somewhere, even parents set up a trust with the equity they've gotten out of their home to that the kids can't touch until they pass away, and then you can set up payments on that. So, so if you have an heir that's not good with their money, um, you're protecting them because it can be stipend out. There's all sorts of options. So you have to be creative, but these are all the questions I ask in the beginning, so I know what the end game is and how to set it up in the beginning. And so again, for my stepmom, none of us want the house. We just didn't want her to have a mortgage. She was able to save some money, and one of the reasons she wasn't going to qualify, she had some debt. And she was actually we were building a new house for her, which has some unique qualities to it that I would advise on. But long story short, it took 6 months to build a house. And when we sold her big house, she had, over $100,000, and we used part of that money to pay off all the debt she had, not cut up credit cards, to pay all the balances down to zero. So in that 6 months while her house was being built, her credit score was going up because she'd paid down all her balances, so that when she got her new cable, she had new cell service because she had a joint with my father. So all of those little things that your credit report matters. She had time to improve on that because I had her use the proceeds to pay off debt, and then she still had money left over for furniture and things that she wanted to buy. And just like someone who'd made a cash transaction, she's in charge of making sure she pays her taxes and homeowners insurance like anybody else. So it really worked out well for her. And like here, I have the advantages of the reverse for purchase. They didn't Credit is not a factor now. The Lisa is just an acronym, meaning we want you to escrow your taxes and insurance in your reverse mortgage. So what happens is you have less access to money, which wouldn't have been advantageous for my stepmom because she wouldn't have been able to afford the house because she would have had to put too much money down. But because of her credit structure, I mean, she was paying on time. She didn't have to escrow her taxes and insurance. So she had enough money to, like I said, down payment, pay off debt, get her credit score up, and have money left over for furniture or whatever emergency fund she needed. In her case, it was actually $106,000 that she had for her rainy day fund after paying down her credit. Now, and the builder, like most builders, would do free upgrades, if you use their lender. Well, their lender didn't know how to do reverse mortgages because I really, quite frankly, didn't want to be involved in the financing of the house just because it's family, and you know how sometimes that can get kind of ugly. But the builder, their lender cannot do a reverse. So I said I'll do it, but she has to have the free upgrades. It's not her fault. She should not be penalized because your lender does not have the ability to do a reverse mortgage. And I think that's something also for any realtors out there. You may have some clients who may think they don't qualify, or don't think they can get a reverse mortgage purchase home because they're not using their lender. But I know how to fix that, because the builder and the sales office, they don't want to lose a purchase, a $417,000 purchase, because they can't do a reverse mortgage. They don't know how to do a reverse mortgage, can't or do not know how to do a reverse mortgage for purchase. Even though those upgrades, it was like 25,000 extra on top of her free upgrades. She had another 25,000, but because she wasn't paying a mortgage, she recouped that money too. So she didn't have to scrimp on whatever. She was very practical about what she got high end and what she didn't, because when you go to those builder selections, the basic package is, I'm going to say, less than basic. So you're going to have upgrades. So not only did she get the free upgrades, but the 25,000 that she extra that she had in upgrades of her own, she's going to recoup in 10 to 11 months. So those are some of the advantages of reverse purchase. A lot of people don't know that it even exists. But for me, I always think, especially in these times with inflation and the economy, it's even though it's getting better, it's always murky waters, especially when you're a senior on fixed income. Uh, I am a big fan of keeping as much money in your pocket, in your bank account, as possible to get into the home that you want to get into. So the all cash payment, I get it, but there's a better way to do it. Good, better, best. Um, Good is having a legit mortgage. Better is, paying all cash. But in my opinion, the best is not paying all cash, not having a mortgage, and having a rainy day fund like you see my stepmom had. Thank you for your time. If there are any questions out there, please reach out in the chat. I don't think you're muted. You may be able to even ask me outright. But here's all my contact information. Please feel free to reach out. That's my cell phone number. I don't have a wife or life, so you can call me 24/7. Even if I don't answer, I will return the call. If you call at 3 a.m., there's a good chance I will answer. So I'll give it a minute for any questions. Doesn't look like there are any. So thank you for your time. Again, Brian Allen, Collab Lending. Always look forward to helping families realize their dreams. All the best.